me, and I could spend all my time thinking about technology. I wouldn't be the 100th or the 1,000th or the 10,000th smartest guy in the country in looking at those businesses. So that is a 7 or 8 foot bar that I can't clear. There are people that can clear it, but I can't clear it, and no matter how I train, I can't clear it. So the fact that there will be a lot of money made by somebody doesn't bother me really. And I mean, there may be a lot of money made by somebody in cocoa beans, but I don't know anything about them. And there are a whole lot of areas I don't know anything about. So, you know, more power to them. And I think it would be a very valid criticism if Charlie and I, if it were possible that Charlie and I, and by spending a year working on it, could become well enough informed so that our judgment would be better than other people's. But that wouldn't happen, and it would be a waste of time. It's much better for us to swing at the easy pitches. Charlie?
Whatever you think you know about technology, I think I know less.
That's probably not true, incidentally. Charlie has a little more of a... He understands some things in the physical world a lot better than I do. But anyway, we'll go to Zone 1.
Good morning. I'm Murray Cass from Markham, Ontario. First off, against my dentist's advice, I'd like to thank you for the free Coke and ice cream last night. Earlier this morning, Mr. Buffett, you mentioned that you liked when wonderful companies like Coke purchased their shares back. Similarly, I own shares in a wonderful company, that's Berkshire. Should I be hoping that you buy your own shares back?
Well, it's interesting. We should have... Perhaps we should have bought some shares back, but usually at the time we could have bought something else that also did very well for us. I mean, maybe when we were buying Coke, we could have been buying our own shares back. To some extent, there hasn't been that much trading in them, but I think it's a valid criticism to say that we have missed the boat at various times in not repurchasing shares. We'll see what we do in the future on it. If it looks like the best thing to do with money, it's what we should be doing. And in the past, I've probably been not optimistic enough in respect to Berkshire compared to other things we were doing with money. Now, the money we spent buying the Geicos and all of that has turned out to be a good use of money too. But we've never wanted to leverage up. That's just not our game. So we've never wanted to borrow a lot of money to repurchase shares. We might advise other people to do it, but it's not our style ourselves. We've got all our money in the company. We've got all of our friends and our relatives' money virtually. So we have never felt that we wanted to leverage up this company like it was just one of a portfolio of 100 stocks. But it's a valid criticism to say that we have not repurchased shares when we should have. And it's also a valid criticism to say that we've issued some shares we shouldn't have issued. Charlie?
Well, I would agree with both comments.
Area 2.
Fellow investors of Berkshire and Hathaway, Warren Buffett and Charlie Munger. I'm from originally China. Now I have a company in Michigan. I want to ask questions based on facts. I want to sell Coke, Geico, and a little book called The Wizard of Omaha, The Investment Philosophy of Warren Buffett in China. Through all the villages, the cities, little towns, I want to make that a reality. Cheers.
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 Zone 3?
I've not asked a question.
Oh, yeah, just warming up. Okay.
Yeah. I will.
They always tell me to get off the stage while you're in good shape, but I'll say it.
I could quit, but you missed your chance. I'm an owner of Berkshire, and I spend 6% of my net worth to be engaged to Berkshire.
Wise decision.
I did better than Guess who? Bill Gates. I noticed Bill Gates and you were traveling on a slow boat in China. I want to go home. On a fast train. You want me to cut me off? If you want me to cut out, fine. Up to the investors. I quit if you want me to quit. I come a long ways. Okay. I know I'm a problem for you. But I'm here for a reason. Because I made some money. I'm going on a train. A smile train. Yesterday, or the day before at the baseball, I asked Mr. Warren Buffett, have you heard of the smile train? He said no. I'm back here to respond. This is a smile train.
Okay, we thank you, but I think that's your question. We better go to zone 4 on that thing.
Good morning or afternoon, actually. My name is Matt Schwab. I'm from New York, Pound Ridge, New York. I actually had a question about the silver purchase last year. When you announced it, you said that you believed that supply and demand fundamentals would only be established at a higher price, reestablished at a higher price. I was just wondering if you could go into more detail about what some of those fundamentals are. I mean, we've read a lot about like battery technology and some other things.
Yeah, we have no inside information about great new uses for silver or anything of the sort. But the situation, and you can get these figures, and they're not precise, but I think they're in general they're generally accurate. You can see from looking at the numbers that aggregate demand, primarily from photography, from industrial uses, and from ornamental jewelry type uses, is close, call it 800 million plus ounces a year. And there are 500 million or so ounces being produced of silver annually, although there will be more coming on in the next couple of years. There's more coming on right now. However, most of that silver is produced as a byproduct in the mining of gold or copper, lead, zinc, so that since it's a byproduct, it's not very responsive to price changes, because obviously if you've got a copper mine and you get a little silver out of it, you're much more interested in the price of copper than silver. So you have 500 million ounces or so of mine production, and you have 150 million ounces or so of reclaimed silver, a large part of which relates to the uses in photography. So there's been a gap in recent years of perhaps 150 million ounces, but none of these figures are precise, which has been filled by an inventory of bullion above ground, which may have been 1.2 billion or more ounces a few years back, but which has been depleted. And no one knows the exact figures on this, but there's no question that the bullion inventory has been depleted significantly, which means that the present price for silver does not produce an equilibrium between supply as measured by newly mined silver plus reclaimed silver and usage. And that eventually something will happen to change that picture. Now, it could be reduced usage, it could be increased supply, or it could be a change in price. And that imbalance is sufficiently large that even though there is some new production coming on, and there is the threat of digital imaging that will reduce silver usage perhaps in the future in photography, but we think that that gap is wide enough so that it will continue to deplete inventories, bullion inventories, to the point where a new price is needed to establish equilibrium. And because of the byproduct nature, which makes the supply inelastic, and because the nature of demand, which is relatively inelastic, that we don't think that price change would necessarily be minor. It's interesting because silver has been artificially influenced for a long time. You saw that movie about, it was William Jennings Bryan who was editor of the Omaha World Herald and a congressman from Nebraska, and whose brother was governor of Nebraska, who was the big silver man, and they used to talk 16 to 1. The 16 to 1 ratio, I think, goes back to Isaac Newton when he was master of the mint. Charlie will know all about that because he's our Newtonian expert here. But that ratio had kind of mystical significance for a while, didn't really mean anything. And in 1934, the government passed an act called the Silver Purchase Act of, surprisingly, 1934, which set an artificially high price for silver at that time, when production and usage was much less. And the U.S. government ended up accumulating 2 billion ounces of silver. Now, this was at a time when demand was a couple 100 million ounces a year, so you're talking 10 years supply. So there was an artificially high price for a while. By the early 1960s, that became an artificially low price of $1.29. And at that time, I could see the inventories of the U.S. government being depleted, somewhat akin to what inventories are being depleted now. And despite the fact that Lyndon Johnson and the administration said they would not demonetize silver, they did demonetize it, and silver went up substantially. That was the last purchase we had of silver, but I've kept track of the figures ever since. The Hunt brothers caused a great amount of silver to be converted into bullion form, including a lot of silver coins. So they again increased the supply in a very big way by their action in pushing the price way up to the point where people started melting it down. So you had these dislocations in silver over a 60-plus year period, which has caused the price to be affected by these huge inventory accumulations and reductions. And we think right now that, or we thought last summer when we started buying it, that at the price we bought it, that was not an equilibrium price, and that sooner or later, and we didn't think it was imminent because we don't wait till things are imminent. We were going to buy a lot of silver. We didn't want to buy so much as to really disrupt the market, however. We had no intention of replaying any Hunt scenario, so we wanted to be sure we didn't buy that much silver. But we liked it. Charlie?
Well, I think this whole episode will have about as much impact on Berkshire Hathaway's future as Warren's bridge playing. We've got a line of activity where once every 30 or 40 years you can do something employing 2% of assets. This is not a big deal for Berkshire. The fact that it keeps Warren amused and
yeah, I didn't like
not doing counterproductive things.
It makes me feel better about all those pictures that people take over the weekend. They all use a little bit of silver.
At least it shows something that teaches an interesting lesson. Think of the discipline it takes to think about something for 3 or 4 decades, waiting for a chance to employ 2% of your assets. I'm afraid that's the way we are. It means there'll be some dull stretches.
Right. Yeah, it's less than $1 billion in silver. It's $15 billion in coke.
It's a non-event.
It's $5 billion in American Express. I mean, it is close to a non-event, but if you see it there,
at least it shows the human personality at work. Very peculiar personality, I might add.
Reinforced by a partner.
Yes.
Okay, let's go to Area 5.
My family is a Class B shareholder. Thank you for issuing those shares. I have one observation and one question. Your Class B share is creating a new phenomena in this country. These baby shares are not only attracting my baby boomer generation, but also X generation and eco generation, your grandchildren. My question is, this next generation would like to hear from you, your investment discipline, your lifestyle, and your philosophy of contributing the wealth back to the society in a language they can understand and communicate back to their friends when they get back to school on Tuesday? Thank you.
Thank you. Well, I appreciate that, and I would say the only speeches I give, I get a lot of requests, perhaps because I don't do them. But I get a lot of requests, including from a lot of our managers in terms of trade conventions, all kinds of things. The only groups I talk to are students, and I try to talk to college and university students, although I've talked to high school students too, whenever it fits in terms of travel schedules. And I just think that you're going to spend your time with groups talking, that rather than entertain people, that it probably is better to talk to the group who talked about it. And Charlie and I are never reluctant to talk, so we do it. Charlie has given a couple of talks. One I sent you a few years ago from USC, but there's been another one recently that I think everybody would profit by reading. So it was reprinted in the Outstanding Investor Digest, but if you write Charlie, I'm sure he'll send you a copy. Area 6, please.
Hi, my name is David Osterbahn. I'm from Kalamazoo, Michigan. This is a hypothetical question about Berkshire. It's going to take a little imagination, I think. The scenario is as follows: that the U.S. Justice Department makes a ruling that Berkshire must split into two parts immediately. You and Mr. Munger must decide which part to keep. You can either choose your marketable securities, Coke, Gillette, Disney, etc., or you can choose your insurance and private businesses. Which one do you choose and why?
Well, that's an easy question for me. I would choose the operating businesses anytime because it's more fun. And I have a good time out of the investments too, but I like being involved with real people in terms of the businesses where they're a cohesive unit that can grow over time. And I wish we owned all of Disney or Coca-Cola or Gillette, but we aren't going to. So if I had to give up one or the other, I'd give up the marketable securities. But it's not going to happen. So we're going to be happy in both arenas, and I look forward to being in both arenas for the rest of my life. Charlie?
Well, I'll be in a hell of a fix if I'm not in the same arena.
We'd both be in a hell of a fix.
Yeah.
Area 7?
Yes, hello to Mr. Munger and Mr. Buffett. My name is Jerry Gonzalez from Plantation. My question is, what are your recommendations of Berkshire Hathaway if Charlie Munger were in charge, or your third man in charge, your third man, which I think you said, it's the CEO of Geico. What are your recommendations?
I missed that fully.
If Charlie Munger were to be in charge fully, 100%, or your third man, the CEO of Geico?
Well, in due course, this corporation will have a change in management. I'm afraid we have no way of fixing that. But we do not, apart from making sure we've got good options and having some system in place, we are not obsessing about a future management yet.
No, well, the directors...
Warren plans to live almost indefinitely.
Absolutely. Although I must say, at my last birthday, somebody asked me how old I was. I said, well, why don't you just count the candles on the cake? And he said he was driven back by the heat. So, but we're not going to leave willingly. And the directors know who, they have a letter that says who they think, who we think should be the ones to succeed us at both the operating aspect and the investment allocation aspect, and that those letters can change over time as we keep hanging around. But I don't worry about the fact that 99% plus of my estate will be in Berkshire Hathaway stock, or that a foundation will eventually receive that stock. So it doesn't bother me in the least. I can't think of a place I'd rather have it. And that includes my appraisal of the managers that we have who can step in and do what Charlie and I do, and who knows, one of them may even understand technology.
I think this place would have very respectable prospects if the top 25 managers all dropped dead at once.
Well, that's not an experiment we intend to pursue.
No, but I see no reason to think it wouldn't continue to do quite well.
Right.
It's been lovingly put together to have a certain margin of safety.
We actually, if we have a choice, it's number 3 through 23, though, that we're 25 that we're interested in. Okay, area 8, please.
This is Raul from Walnut Creek, California. Thanks, Mr. Buffett. Thanks, Mr. Munger. Thanks for your great company. Wish I had known about it 10 years ago. You are not only the greatest, but the most honest. I want to commit 99% of what I have to Berkshire Hathaway, and I will. The question I want to ask is, how do you calculate the intrinsic value of the company? And based on intrinsic value, to me, Berkshire Hathaway looks a great bargain at these prices, especially based on look-through earnings. Is that true? And one last question I want to ask, just for fun. What do you think about telecom IPOs like Quest, USLEC? They seem to pop up 50% at opening. Does it make any sense to invest in these? Thank you very much.
Charlie, you want to tackle that?
I didn't follow that all. Intrinsic value, we give you the facts and you make your own conclusions. I like the fact that you think we're honest, but you know, if you people keep bidding up the price of our stock, honesty will only do so much for you in the future.
Yeah, we've never been tested. I mean,
Yeah.
We're very lucky. We've never had, we've never had anything that we needed really that we haven't had. And who knows what the situation would be if your family was starving or something. So our intention is to continue in a position where we'll never be tested too, I might add. The intrinsic value question, I mean, by definition, intrinsic value is the present value of the stream of cash that's going to be generated by any financial asset between now and doomsday. And that's easy to say and impossible to figure, but it's the kind of thing that we're looking at when we look at a Coca-Cola, where we think it's much easier to evaluate the stream of cash that comes in the future than it is in a company such as Intel, marvelous as it may be. It's easier for us. It may not. Andy Grove may be better at figuring out Intel than Coke. And in Berkshire, it is complicated by the fact that we have no business that naturally employs all of the capital that flows to us. So it is dependent to some extent on the opportunities available and the ingenuity used in when that cash pours in, as it does. Some businesses have a natural use for the cash. Actually, Intel has a good natural use for the cash over time as they've expanded in their business, and many businesses do. But we do not have a natural use. We have some businesses that use significant amounts of cash. Flight Safety will buy a lot of, build a lot of simulators this year, and they cost real money. But in relation to the resources available, we have to come up with new uses, new ways to use cash, and that makes for a more difficult valuation job than if you've got, well, the classic case used to be a water or electric utility where the cash could be deployed and the return was more or less guaranteed within a narrow range. And it was very easy to make calculations then as to the expectable returns in the future. But that's not the case at Berkshire. We've got very good businesses, and both directly and partially owned, and those businesses are going to do well for a long, long time. But we do have new cash coming in all the time, and sometimes we have good ideas for that cash, and sometimes we don't, and that does make your job more difficult in terms of computing intrinsic value. We'll have, we're going to break after the next question. At that time, we break whenever Charlie and I run out of candy up here, actually. We're going to let everybody that you can get something to eat if you want to stick around, and we will be here till 3:30 when we reconvene at 12:30. And those of you who have been with us this morning and have had enough, we thank you for being here this weekend. We've had a terrific time with you, so I'm very appreciative of that. Let's have a question from Zone 9, and then we'll go to lunch.
Good morning. My name is Frank Jervich. I'm a shareholder from London, Ontario, in Canada. My question is for Mr. Munger, and it concerns his models. And the question specifically is related to market valuation. I know I'm not going to get a prediction, that's not your bag. What I'm curious about is there any specific touchstone models that you reflect upon and trying to gain perspective at these markets where the historic valuations are quite high? And why do you draw on those models? My second question is for Mr. Buffett, and it relates to taxation. If you were able to trade your portion of your portfolio, at least in a tax-exempt fashion, like 401k plans, or in Canada, the RSP plans, would you possibly trade more actively?
Charlie, you want to answer yours first?
Yeah. Well, the Munger system for dealing with reality is to have multiple models in the head and then run reality against multiple models. I think it's a perfect disaster to look at reality through just one model or two. There's an old proverb that says, to the man with only a hammer, every problem looks pretty much like a nail. And that is not our system. So I can't sit here and run through all the models in my head, even though there aren't that many. But multiple models is the game.
The question about taxation, it would not, if we were running Berkshire absent a capital gains tax, I don't think it would make much difference in what we do. I don't think it would make, it certainly wouldn't make a difference in causing us to trade actively. We own the businesses we want to own. We don't own them because taxes have restrained us from selling them. And as I mentioned earlier, I'm fairly sure we'll pay at least $1 billion in income tax this year. We might not, but it looks that way to me, that we'll pay $1 billion. And I could do things that at least deferred, and I certainly could do things by doing nothing that avoided paying that $1 billion in tax, or a good bit of the $1 billion, call it 800 million of the $1 billion. But that is not a big factor with me. It's never been a big deal with me. I paid my first income tax when I was 13, so I guess I got brainwashed at the time, and it doesn't bother me a lot to be paying taxes. I think personally, I'm undertaxed in relation to what the society has delivered to me. And I don't send along any voluntary payments to the IRS. I want you to understand, but I really do. I mean, there's nobody I want to trade places with, and because their tax situation is better than mine, and so it would not increase the activity. I've been asked to take one more question from Zone 10. I'm not sure why, but maybe because they see that I still have candy up here. So Zone 10, please, and then we'll break.
Mr. Buffett and Mr. Munger, my name is Sanjeev Merchandani, shareholder from Boston. First of all, thank you to both of you for everything. I have two questions. For you, Mr. Buffett, you obviously have filters that you apply on selecting people as you do on stocks. Can you tell us a little bit about what those filters are?
Filters on people?
Yes, in selecting, you have an ability to motivate people who have a lot of money to keep working. What do you look for to figure out who those people are?
Well, that is a key question, because when we buy businesses, we don't have managers to put in them. I mean, we're not buying them that way. We don't have a lot of MBAs around the office that we're...
Thank God.
Yeah. that I have not promised that they're going to have all kinds of opportunities. So, as a practical matter, we need management with the businesses that we buy. And 3 times out of 4 or thereabouts, the manager is the owner and is receiving tens of millions, maybe hundreds of millions of dollars. So they don't have to work. And we have to decide in that time when we meet them whether they love the business or love money. And we're not making a moral judgment. Charlie may, but I'm not making a moral judgment about whether it's better to love the business or love money. But it's very important for me to know which of the two is the primary motivator with them. And we have had extremely good luck in identifying people who love their business. And so all we have to do is avoid anything that on our part that diminishes that love of the business or makes other conditions so intolerable that they overcome that love of the business. And we have a number of people working for us that have no financial need to work at all, and they probably outwork 95% or more of the people in the world, and they do it because they love smacking the ball. And we virtually had no mistakes in that respect. And we have identified a number of people, Charlie and I have, in terms of proposals to us, where we felt that they liked the money better than the business. They were kind of tired of the business, and they might promise us that they would continue on and they would do it in good faith, but something would happen 6 months later or a year later, and they'd say to themselves, why am I doing this, for Berkshire Hathaway when I could be doing whatever else they want to do? I can't tell you exactly what filter it is that we put them through mentally, but I can tell you that if you've been around a while, I think you can have a pretty high batting average in coming to those conclusions, as you can about other aspects of human behavior. I'm not saying you can take 100 people and take a look at them and analyze their personalities or anything of the sort, but I think when you see the extreme cases, the ones that are going to cause you nothing but trouble or the ones that are going to bring you nothing but joy, I think you can identify those pretty well. Charlie?
Well, yeah, I think it's pretty simple. You've got integrity, intelligence and experience and dedication. And that's what human enterprises need to run well. And we've been very lucky in getting this marvelous group of associates to work with all these years. It would be hard to do better, I think, than we've done in that respect. Look around this place. I mean, and particularly you young people, look around this place. Look at how much gratification can come into these lives, which have been mostly spent in deferring gratification. It's a very funny group of people, you shareholders.
Well, on that note of self-congratulation, let's go have lunch, and we'll be back in half an hour. Let's settle down, please, and we're going to go to, we skipped one last time, so we're going to go first to zone 4.
Hello. My name's Nelson Arata. I'm from Southern California, and I have a question. It's not really related to intrinsic value or any of that stock stuff, but more on houses. I'm still quite young. I don't have a house yet, and I'm thinking about buying a house someday soon. And in order to do that, I'm going to have to put a down payment, which means I might have to share or sell my shares. And I was wondering if you can provide some insight on when is the best time to buy a house and how much down payment you should be putting down in relation to interest rates and also in relation to available cash and the stock market.
Well, Charlie's going to give you an answer to that in a second. I'll just relate one story, which was when I got married, we did have about $10,000 starting off, and I told Susie, I said, now, you know, there's two choices. It's up to you. We can either buy a house, which will use up all my capital, clean me out, and it'll be like a carpenter who's had his tools taken away from him, or you can let me work on this, and someday, who knows, maybe I'll even buy a little bit larger house than would otherwise be the case. So she was very understanding on that point, and we waited until 1956. We got married in 1952, and I decided to buy a house when the down payment was about 10% or so of my net worth, because I really felt I wanted to use the capital for other purposes. But that was a way different environment in terms of what was available to buy. In effect, if you have the house you want to buy, I definitely believe in just going out and probably getting the job done. But in effect, you're probably making something in the area of a 7 or 8% investment implicitly when you do it. So, you'll have to figure out your own equation from that. Charlie probably has better advice on that. He's a big homeowner. In both senses of the word.
I think the time to buy a house is when you need one.
And when do you need one?
Well, I have very old-fashioned ideas on that, too. The single people, I don't care if they ever get a house.
When do you need one if you're married, Charlie? I'll follow up here for this. You need one when your wife wants one. But
Yes. I think you've got that exactly right.
Yeah. Sure.
Gregory Crawford needs to go to the security office, please, for emergency message. Gregory Crawford to the security office for emergency message. Thank you.
Okay. Hope it isn't a margin call. Okay, we'll go to zone 1, please.
I'm Ralph Pfeffer from Phoenix, Arizona. The question I'm going to ask does not pertain to Berkshire Hathaway, but I would appreciate it if you gentlemen, if you can, explain the justification and rationalization for the exorbitant salaries, bonuses, perks, directors' fees, and other benefits that most public corporations are paying.
Well, I would say this. In my own view, the most exorbitant are not necessarily the biggest numbers. What really bothers me is when companies pay a lot of money for mediocrity, and that happens all too often. But we have no quarrel in our subsidiaries, for example, for paying a lot of money for outstanding performance. I mean, we get it back 10 or 20 or 50 for one. And similarly in public companies, we think that there have been managers and are managers who have taken companies to many, many, many billions of market value, more than would have happened with virtually anyone else. And they sometimes take a lot of money for that. Sometimes, as in the case of Tom Murphy at Cap Cities, you know, it just didn't make a difference to him. I mean, he performed in a way that would have justified huge sums, but it wasn't. I mean, he would tell you that he had all the money he needed, so, and he just didn't care to take what the market might bear. But I am bothered by irrational pay systems, and I'm particularly bothered when average managers take really large sums. I'm bothered when they design or have designed for them systems that are very costly to the company, maybe partly to make themselves look good because they want huge options themselves, so they feel like they give options widely throughout the company. So they design a system that is illogical company-wide because they want one that's illogical for them personally. But large sums per se don't bother me. I'm not saying, you know, whether any individual might want to take them or not. But I do not mind paying a lot of money for performance. It's done in athletics, it's done in entertainment, but in business, the people who are the 200 hitters and the people who would not attract a crowd as an entertainer have worked it out so that, I mean, the system has evolved in such a way that many of them take huge sums, and I think that's obscene, but I can tell you there isn't much you can do about it. The system feeds on itself, and companies do look at other companies' proxy statements. Every CEO does, and they say, well, if Joe Smith is worth X, I have to be worth more. And they tell the directors that certainly you wouldn't be hiring anybody that was below average, so how can you pay me below average? And the consultants come in and ratchet up the rewards, and it's not anything that's going to go away. It's like we were talking about campaign finance reform earlier. The people who have their hands on the switch are the beneficiaries of the system. Who have their hands on the switch are the beneficiaries of the system, benefiting enormously and perhaps disproportionately from that system. Charlie?
Well, yeah, I'd like to report that the original Vanderbilt behaved even better than the people at Berkshire Hathaway. He didn't take any salary at all. He thought it was beneath him as a significant shareholder to take a salary. That ideal, I'm afraid, died with him.
Yeah, Charlie and I, our directors are paid $900 a year, but I tell them on an hourly basis they're making a fortune because we don't work them that hard. But what Charlie and I did not think through when we established that $900 a year is that they set our salaries too. So we have not followed the standard procedure, which is to load it on the directors, and the directors shall load it on you.
I do think it will have pernicious effects for the country.
Load it on you.
I do think it will have pernicious effects for the country. It's escalating because I think you're getting at the very top, corporate salaries in America are too high. And that is not a good thing for a civilization when the leaders are regarded as not dealing fairly with the institutions that they head.
You know, if
all I can say is that prostitution would be a step up for them.
Put him down as undecided. Zone 2, please.
I'm Dan Blum from Seattle, Washington, via Cambridge, Massachusetts. I want to ask whether the issuance of Class B stock has achieved the objective which you announced for it when it was created.
Well, I would say this, that considering the alternatives we faced, which was the imminence of unit trusts that would have been promoted with heavy front-end commissions, with substantial annual fees, with bad tax consequences, and with probably a misrepresentation of the historical record in such a way that people who really didn't know much about securities would have been enticed in. With that as an alternative, I think the B stock was the best thing we could have done, and I feel good about how it's worked out. I think that, you know, we didn't set out to issue it. We don't like talking anybody into buying our stock, but I don't think in any way that the group we have here is diminished in the least by having a mix of B and A shareholders as opposed to A only. The B has worked out as well as possible. I hope that we haven't enticed anybody in with unreasonable expectations. That's the biggest thing that Charlie and I worry about. And it's hard not to have that happen with the historical record. I know it would have happened in a big way with the unit trust. So, it's like making the mistake originally of starting with Berkshire. I think we enjoy things as they come along, and we've gotten a good group with the B shareholders, and we're happy with the present situation. Charlie?
Yeah, we wanted to step hard on what we regarded as a disreputable financial scheme, and that we did.
And I think the way we sold the B was such as to attract the kind of people who really did look at it on a long-term basis. We did everything we could to discourage people who thought they were going to make a lot of money in a hurry. So I think we attracted a whole new group of shareholders who were quite similar in perspective to the shareholder group that we already had, and that was our hope. Zone 3, please.
My name is Alan Rank from Pittsburgh. I first want to thank Susan Jacques for returning the cocktail yesterday, and I hope she was rewarded with good sales at Borsheim's. Question is regarding the fact that you don't report details of anything under $750 million, and with the change of the values of small cap in relation to large cap, would that be something that Berkshire or individuals might try to look as opportunity with the small cap premium shrinking as it has?
We don't worry about whether a stock is small cap or large cap, except to the extent that by now we've gotten to a point where anything below a certain level just is not of interest to us because it can't be material to our results. So we never think of opportunities as existing because of something as small cap or sectors or all that, what generally gets merchandised. So our cutoff point is set more or less at the point where we think it's material. That's not as defined by the SEC. We could have a higher limit, but we think when you get down below 2% of assets or thereabouts, that the reporting of positions would not affect anybody's calculation of intrinsic value or give them insights about the way we run the business, but it would be more for the people who are looking for things to piggyback on. And so we will move the cutoff point up as we go along. Because of our size, we will never be in companies that have capitalizations that of $500 million or $1 billion, because we just can't put enough money in. Occasionally we'll be in one just by accident, but we're looking at things that we can put $500 million in ourselves, at least. At $500 million, a 5% position is a $10 billion market cap, and that limitation has hurt, will hurt, is hurting our performance to some degree. If Berkshire were exactly 1/100th of its present size, in all respects owning the operating businesses it did, but all 1/100th the size, our prospects would be better than they are with the kind of money we have presently. Charlie?
I've got nothing to add.
Okay, Zone 4, please.
Okay. My name is Tom Conrad. I'm from McLean, Virginia. I just wanted to first thank you, Mr. Buffett and Mr. Munger, for each year answering our questions. I found myself at 5 a.m. standing outside the door here, and I don't do that for anyone. And it's a real pleasure to hear your answers. I have two questions. One is, with Travelers, the company Travelers, and their merger with Citibank, do you have confidence in the management of Sandy Weil? My second question is, you said it in a few meetings ago that diversification is a protection against ignorance. And it only takes 3 great companies to be set for an investment lifetime. And I invested in those 3 companies, Coca-Cola, Gillette, and Disney. And I went ahead and invested in a 4th company without asking you. I invested in Pfizer. And I just wonder what you think about the pharmaceutical industry, if you feel there's some great companies in that industry. Thank you very much.
Yeah, well, we think Sandy Weil is a very, very good manager. Sandy is, the record is clear. It is not easy to manage in Wall Street. And Sandy has done an excellent job there, as well as in other allied or somewhat allied fields. So his record is proven. And he has done ever since buying commercial credit from Control Data, he's built a terrific company. And he's built a terrific company in businesses that themselves aren't necessarily so terrific. So it's required real management skill. Pharmaceuticals, we missed. We would not have known how to pick out any single business, single company within the industry. But we certainly should have didn't do anything about it, that the industry as a whole represented a group that would achieve good returns on equity, and where some sort of a group purchase might have made sense. We did buy one a while back, but we didn't. It was peanuts, and it would have been. It was within our circle of competence to identify the industry as likely to enjoy very high profits over time. It would not have been within our circle of competence to try and pick a single company. Charlie?
Yeah, we stupidly blew that one.
We'll blow more, too. Zone 5.
Yes, sir. Good afternoon. My name is Matt Lovejoy from Lexington, Kentucky. And gladly, I'm not a consultant. I have a question, sir, Mr. Buffett, about your operating management style. In my opinion, the mainstream media minimizes the significance of your non-public operating investments. When you consider capital allocation in these companies, do you have the managers submit annual business plans? And if so, do you formally meet with those managers to see how well you can track progress against those plans?
Yeah, that's a good question, and the answer is that we may meet with some of them annually, we may meet with others semi-annually, but we have no formal system whatsoever, and we will never have a formal system. We don't demand any meetings of any of our managers. We have no operating plan submitted to headquarters. Some of the companies use operating plans themselves, some of them don't. They are all run by people who have terrific records, and they have different batting styles. And we're not about to tinker with somebody that's batting with 375 just because somebody else holds the bat a little differently or uses a different weight bat or something of the sort. So we believe in letting them do currently and in the future what has been successful for them in the past. And different people have very different styles. I've got my own style, but we have managers that like to talk things over. We have other managers that like to go their own way. And we have managers that have a by-the-book approach, which works well. We have other managers that wouldn't dream of that. We have most managers probably have monthly statements of financials. We have other managers that don't. And that really isn't a problem. What we want to have is good managers. And there's more than one way to get to at least business heaven. And and we have a number that have found different ways to get there. So we have never imposed. We have certain requirements because we're a public company and SEC requirements and Internal Revenue Service coordination, but we have never imposed anything from the top on any of the operating managements. We have MBAs running companies. We have people that never saw a business school, and talent is the scarce commodity. And when you find talent and they've got their own way of doing things, we're delighted to have them do it. More than letting them have them do it, we want them to do it their way. We don't want to change them. Charlie?
Yeah, the truth of the matter is that we have decentralized power in the operating businesses to a point just short of total abdication. And we don't think our system is right for everybody. It has suited us and the kind of people that have joined us. But we don't have criticism for other people like Emerson Electric or something who have operating plans and compare performance quarterly against plan and all that sort of thing. It's just not our style.
Yeah, we centralize money, and everything else we decentralize pretty much. But I don't know whether you've met him here, but for example, Al Yolshi is here. He started flight safety in 1951, and I don't know what he'll spend on simulators this year, but it could easily be $100 million or thereabouts. And if I spent hours with him, I couldn't add 1/100th of 1% to his knowledge of how to allocate that money. I mean, it would be ridiculous. It'd be a waste of his time, and it would be an act of arrogance on my part. And I have no worries about how Al allocates the money. And that's an unusually capital-intensive business compared to most of our businesses. There's some that I get into the details more because I've just worked with a person that's running things a long time, and we kind of enjoy it. Ajit and I talk virtually every night about the reinsurance business. I am not improving the quality of his decisions at all, but it's an interesting game, and I like hearing about it, and he doesn't mind talking about it, so we talk them over. But that's just a matter of personal chemistry. And as we add managers, we will adapt to them. We adapt our accounting systems to a degree to them. Now we do have certain requirements that result from the SEC and IRS, but we don't. Our managers know their businesses, and they know how to run them. And if they don't, this hasn't been the case, but if they didn't, we'd do something about the manager. We wouldn't try and build a bunch of systems. Zone 6, please.
Good afternoon, gentlemen. My name is George Donner from Fort Wayne, Indiana. My question has to do with estimating the intrinsic value of a company, in particular the capital-intensive companies like you were mentioning. I'm thinking of things like McDonald's and Walgreens, but there are lots of others where you have a very healthy and growing operating cash flow, but it's largely or completely offset by heavy expenditures on putting up new stores or restaurants or building a new plant. And so my question is, what do you do for your estimate of future free cash flow? And with treasuries long treasuries around 6%, at what rate do you discount those cash flows?
Well, we discount at the long rate just to have a standard of measurement across all businesses. But we would take the company that is spending the money as it comes in, and they don't get credit for gross cash flow. They get credit for whatever net cash is left every year. But of course, if they're spending the money wisely, even though you have to discount it for more years, the growth in cash development should offset that, or they weren't investing it wisely. The best business is one that gives you more and more money every year without putting up anything to get it, or very little. And we've got some businesses like that. The second best business is a business that also gives you more and more money. It takes more money, but the rate at which you reinvest the money to get that growth is a very satisfactory rate. The worst business of all is the one that grows a lot and where you're forced in effect to grow to stay in the game at all, and where you're reinvesting the capital at a very low rate of return. Sometimes people are in those businesses without knowing about it. But in terms of discounting, in terms of calculating intrinsic value, you look at the cash that is expected to be generated, and you discount back. In our case, we use the long-term treasury rate. That doesn't mean that you pay the amount that present value calculation leads to, but it means that you use that as a common yardstick, that treasury rate. And that means if somebody is reinvesting all their cash flow the next 5 years, they better have some very big figures coming in down the road, because at some day a financial asset has to give you back cash to justify you laying out cash for it now. Investing is the art, essentially, of laying out cash now to get a whole lot more cash later on, and something at some point better deliver cash. Ben Graham in his class we used to talk about what he called the Frozen Corporation. And the Frozen Corporation was a company whose charter prohibited it from ever paying anything to its owners, or ever being liquidated, or ever being sold. And
sort of like a Hollywood producer.
Yeah. And the question was, what was such an enterprise worth? Well, that's sort of a theoretical question, but it forced you to think about the realities of what business is all about. And business is all about putting out money today to get back more money later on. Charlie?
I do think there is an interesting problem that you raise, because I think there is a class of businesses where the eventual cash back part of the equation tends to be an illusion. I think there are businesses where you just keep pouring it in, and then all of a sudden it doesn't work and no cash comes back. And what makes our life interesting is trying to avoid those and get on the alternative kind that drowns you in cash.
The one figure we regard as utter nonsense is the so-called EBITDA. I mean, the idea of looking at a figure before the cash requirements of merely staying in the same place, and there usually are. Any business with significant fixed assets almost always has with it a concomitant requirement that major cash be reinvested in order simply to stay in the same place competitively and in terms of unit sales. To look at some figure that is before that is stated before those cash requirements is absolute folly, and it's been misused by lots of people to sell lots of merchandise in recent years.
It's not to the credit of the investment banking fraternity that it has learned to speak in terms of EBITDA. I mean, the idea of using a measure you know is nonsense, and then piling additional reasoning on that false assumption, it's not creditable intellectual performance. And then once everybody is talking in terms of nonsense, why, it gets to be standard.
Zone 7, please.
Hi, my name is Brandon Vecchio, and I'm in the Academy of Finance at Northwest High School here in Omaha. Could you explain the criteria you look at when selecting your stocks?
Well, we look at, and I'm glad you came. I hope there's a large group. I got a note, I think, from your teacher on that. We look at it, the criteria for selecting a stock is really the criteria for looking at a business. We are looking for a business we can understand. That means they sell a product that we think we understand, and we understand the nature of their competition, what could go wrong with it over time. And then when we find that business, we try to figure out whether the economics of it, means the earning power over the next 5 or 10 or 15 years, is likely to be good and getting better or poor and getting worse. But we try to evaluate that future stream. And then we try to decide whether we're getting in with some people that we feel comfortable being in with. And then we try to decide what's an appropriate price for what we've seen up to that point. And as I've said last year, what we do is simple but not necessarily easy. the checklist that is going through our mind is not very complicated. Knowing what you don't know is important, and sometimes that's not easy. And knowing the future is definitely it's impossible in many cases in our view, and it's difficult in others, and sometimes it's relatively easy, and we're looking for the ones that are relatively easy. And then when you get all through, you have to find it at a price that's interesting to you, and that's very difficult for us now, although there have been periods in the past where it's been a total cinch. And that's what goes through our mind. If you were thinking of buying a service station or a dry cleaning establishment or a convenience store in Omaha to invest your life savings in and run as a business, you think about the same sort of things. You think about the competitive position and what it would look like 5 or 10 years from now, and how you were going to run it, who was going to run it for you, and how much you had to pay. And that's exactly what we think of as when we look at a stock, because a stock is nothing other than a piece of a business. Charlie?
Yeah, if finance were, when finance is properly taught, it should be taught from cases where the investment decision is easy. And the one I always cite is the early history of National Cash Register Company, and that was created by a fanatic who bought all the patents and had the best sales force and the best production plants, and he was a horse in the best production plants, and he was a very intelligent, was a godsend to retailing when cash registers were invented. So that was the pharmaceuticals of a former age. If you read an early annual report prepared by Patterson, who was CEO of National Cash Register, an idiot could see that this was a talented fanatic, very favorably located, and that therefore the investment decision was easy. If I were teaching finance, I would collect 100 cases like that, and that's the way I would teach the students.
We have that annual report. What was that, 1904 or something, Charlie? But it's really a classic report, because Patterson not only tells you why his cash register is worth about 20 times what he's selling for to people, but he also tells you that you're an idiot if you want. But he also tells you that you're an idiot if you want to go in competition with him. It's a classic.
It is just a total report and not realize that this guy can't lose.
Area 8, please.
Good afternoon. My name is Robert Rowland from London, England. I've been in Omaha all weekend with my wife on the first leg of my honeymoon, and I've noticed you're quite a buyer of nostalgic assets. Can I ask whether nostalgia is one of your filters? Are there any assets like that left in the US to buy? And if not, can I suggest you come to the UK, where all we do is sell them?
Well, I don't want to interrupt your honeymoon, but if you'd send me a list of those companies over there that are long on nostalgia, that might be to our liking, because Charlie and I tend to operate from sort of a Norman Rockwell frame of mind, and it is true that the kind of companies we like sort of do have a homey Norman Rockwell Saturday Evening Post type character to them. They have character. And they're the kind of companies, I think, frequently that people, when they join them, expect to spend the rest of their lives there, rather than look at it as something to stick on the resume. And there are businesses like that. If you look at the businesses that we've bought in the last 3 or 4 years, there is real character to the businesses and to the people that build them, and that's why the people that build them stay on and feel very strongly about running them correctly, even though it can have no financial consequence to themselves whatsoever. So even though it can have no financial consequence to themselves whatsoever. So after your honeymoon, drop me a line. Zone 9, please.
Good afternoon. Joshua Andrews from Omaha Northwest High School, Academy of Finance.
Good.
And on behalf of the Academy of Finance, we want to thank you for the tickets. There's 33 of us in attendance today.
Terrific.
we had the opportunity to play a national game, an investment challenge, and on the list of stocks there were Berk A and Berk B. Can you explain what the difference of the two stocks are?
Yeah, the difference between the Berkshire A and B is simply that an A can be converted to a B at any time in the ratio of 1A into 30 Bs. The B cannot be converted into the A, so it's a one-way street into 30 Bs. The B cannot be converted into the A, so it's a one-way street on of the B is exist. So anytime the A ever gets any money of any kind from dividends or liquidation or a merger or something of the sort, for every $30 that you get on the A, you're going to get $1 on the B. The two differences are that there is less voting power proportionately in the B, and the B does not participate in a designated contributions program that Berkshire runs, simply because that would be very, very hard to administer. And when we issued the B, we pointed out those two differences. The B should never sell for more than 1/30th of the price of the A. When it sells just a tiny bit above that, then arbitrage settles in as people buy the A and convert it to B and sell the B. Occasionally the B may be at a slight discount to the A because it's not convertible the other way. But I think as a practical matter, you can treat the A and B as very equivalent investment choices. There's A and B as very equivalent investment choices. There's area 10, please.
My name is Sheena Sho from the Academy of Finance. What recommendations would you give us as teenagers to prepare for our future and become as successful as you?
Well, if you're interested in business, I definitely think you ought to learn all the accounting you can by the time you're in your early 20s. Accounting is the language of business. Now, that doesn't mean it's a perfect language, so you have to know the limitations of that language as well as all aspects of it. So I would advise you to learn accounting, and I would advise you to be, in terms of part-time employment or anything else, work at a number of businesses. There's nothing like seeing how business operates to build your judgment in the future about businesses. When you understand what kind of things are very competitive and what kind of things are less competitive and why that works that way, all of that adds to your knowledge. So I would do a lot of reading. If you're interested in investments, I would take the accounting courses. I do a lot of reading about investments, and I would get as much business experience. I would talk business with people that are in business to find out what they think makes their operation tick or where they have problems and why. I just think you just kind of sop it up every place that you can, and if it turns you on, you'll do well in it. I mean, I think that if it there certain activities grab different people, but if business is of interest to you, my guess is you'll do well. And if you understand business, you understand investments. Investments are simply business decisions that in terms of capital. Investments are simply business decisions that in terms of capital.
Yeah, there's also the little matter of underspending.
Mastered.
Yes. That really works if you keep at it.
Yeah, I mean, Charlie and I both. Charlie started having children at a rapid rate, so he was a lawyer when there was not big money, and then, but I was any money you save before you get out and start having a family is probably worth any dollar is probably worth $10 later on, simply because you can save it. It's the time to save is young, and you'll never have a better time to save than really pre-formation of a family, because the expenditures come along then, whether you like them or not. So work for yourself first and put the money aside. I was lucky that way. I didn't have to pay for my own college probably wouldn't have gone to college if I'd had to pay for it. But I was able to save everything I made in my teens, and those dollars got magnified quite a bit. Whereas the money when I started first selling securities, I mean the money I made then was taken up by family needs to quite an extent. So start saving early. A lot of it's habit anyway, so it's a great habit to have. Okay, zone 1, please.
I'm Tony Alsnett from New York City. Following up on the questionnaire from London, in light of the current dearth of investment opportunities, do you see yourselves investing in non-U.S. companies which are well managed, understandable, and growing?
Well, if we find such companies as you describe at a price that's half attractive, we're perfectly willing to buy them. So the answer to that is yes, but we would be looking to an extent worldwide, irrespective of market conditions in the United States. Now, market valuations in this country tend to be fairly well matched in most of the major countries. So there's been a bull market all over the world in a huge way in the bigger markets, and so unfortunately, I mean, it would have been nice for us if the U.S. market had tripled and other markets had stayed the same, and then we would be very likely to be finding things abroad. We're not finding them abroad, but we're certainly looking for the kind of thing you're talking about. We are not reluctant to invest abroad, and our all three of our largest holdings, American Express, Gillette, and Coke, and we're talking about $25 billion of market value there that we have. All three of those have major businesses abroad, and in the case of Coke and Gillette, it's a majority of their earnings from abroad. So we're interested, and there's better growth opportunities in many areas abroad than here. Finding bargains as we look around the world. Charlie?
Nothing more.
Okay. Area 2.
My name is Henry Allen, Mamaroneck, New York. Question I have is a little delicate, relates to my family and heirs rather than myself, because I'm a couple of decades older than you gentlemen. You've been very candid about the succession and the estate planning, but how will the recipients of huge grants, charitable grants, get the liquidity they need to use the money without unduly driving the stock down?
Well, I don't think that supply and demand in terms of specific, let's just say that 3% of Berkshire were to be added to the supply annually. I don't think that makes much difference. What really makes the difference is the prospects of the business. If my charitable foundation were operative today, it would have to sell. It would have to give away 5% of the value of the foundation every year, and if Berkshire paid no dividend, that means it would have to sell 5% of the holdings per year. I don't think that the price of Berkshire would be materially different if there were a seller of, that would be, in this case, 2% of Berkshire's capitalization. I don't think it would be materially different. If it is, it probably should be different. I mean, there should be a reasonable amount of trading that can take place annually without affecting the price of the stock materially, or the price of the stock is being propped for sort of unnatural reasons. So I wouldn't really worry about that. We had one shareholder die about a year and a half ago that had 0.75% of the company, for example. It was sold in, I don't know, 6 weeks or thereabouts, and they raised at that time $250 million or thereabouts from the sale. I am not worried about that. I'm worried about I mean, I don't worry, but the key factor is what are the prospects of the businesses. If the businesses are worth money, there are all kinds of companies on their stock exchange who are perfectly decent businesses where 30 or 40% of the stock turns over a year, and Berkshire's price should not be way different if 10% trades a year as opposed to the present 3%. Charlie?
I agree with that. I don't think there'd be any problem at all at the present time if the Buffett Foundation were selling 5% of its holdings every year.
It'd be 500 shares a week or something like that. But if there isn't demand for 500 shares a week on a company with our capitalization, then the price probably is artificially wrong at that time.
I just had lunch with Susie, and she doesn't look to me like she's in any imminent danger of mortality.
Yeah, it will come into play when the survivor of the two of us dies, and when the estate gets cleaned up and everything else. So I think, certainly hope, and I think it's quite a ways away.
You people have more important things to worry about.
Zone 3, please.
My name is Jim Howard. I'm from Syracuse, Indiana. My question is, does the book Buffettology by Mary Buffett present fairly in all material respects the calculations you used in evaluating a business for purchase, or did the lady just write a book?
Well, it was written by two authors, but I would say that no, I would say that in a general way it gets at the investment philosophy, but I wouldn't say that it's not the book I would have written precisely, but I have no quarrel with it either. I actually think by reading Berkshire's reports, you should be able to get more. I would think you get more of our philosophy than in any other manner. I think Larry Cunningham, the fellow who held the symposium at the Cardozo School at Yeshiva, did the best job actually of sort of reconstructing the various things that have been written at Berkshire into sort of the best organized presentation of our philosophy. So
he's selling it right here. It's a very practical.
Yeah, he had it at Borsheim, in the mall outside Borsheim yesterday, and Larry did a very good job, and I had nothing to do with it, but I think I really think he's done a first-class job of sort of organizing by topic. I mean, all these things that I've sort of written annually, and Charlie's written over time. So that would probably be my, if I were picking one thing to read, that would probably be the one. Okay, Zone 4, please.
My name is Leora Garner. I'm from Los Angeles, California, and I want to begin by thanking you for having Bob Hammond. It was a stroke of genius. I could shop at Borsheim's, and my husband was entertained while I did so.
Well, Bob is not only the best bridge player around, but he is an entertaining guy, too.
He's great.
Yeah, he is great. I agree with you.
My question. You owned Disney once before and sold it. You also owned advertising companies in the 70s, I believe.
Right.
And you sold them. Could we have some insight into your thinking as to why you sold them?
I'm not sure I want to give you any insight into that thinking. Well, we'll start off with the fact that when I was 11, I bought some City Service Preferred at 38, and it went to 200, but I sold at 40. So, grabbing my $2 a share of profit. So everything we've ever sold has gone up subsequently, but some of them have gone up more painfully subsequently than others. And certainly the Disney sale in the 60s was a huge mistake. I should have been buying. I did forget about holding. And that's happened many times. I mean, we think that anything we sell should go up subsequently because we own good businesses, and we may sell them because we need money for something else, but we still think they're good businesses, and we think good businesses are going to be worth more over time. So everything virtually that I can think of has gone on to sell it at a lot more money, for a lot more money, and I would expect that would continue to be the case. That's not a source of distress, but I must say that selling to Disney was a mistake, and actually the ad agencies have done very well since we sold them too. Now maybe some of that money went into Coca-Cola or something else, so I don't worry about that. I would worry, frankly, if I sold a bunch of things right at the top, because that would indicate that in effect I was practicing the bigger fool type approach to investing, and I don't think that can be practiced successfully over time. I think the most successful investors, if they sell at all, will be selling things that end up going a lot higher, because it means that they've been buying into good businesses as they've gone along. Charlie?
Well, I'm glad that the questioner brought this touch of humility, because it is really useful to be reminded of your errors. I mean, and I think we're pretty good at that. I mean, we kind of mentally rub our own noses in our own mistakes, and that is a very good mental habit. Warren can tell you the exact number of cents per share that he sold at, and compare it with the current price. It actually hurts him.
It actually doesn't hurt. The truth is, because you just keep on doing things. But it is instructive to do postmortems on everything, and say, as long as you don't get carried away with it. But every acquisition decision, that kind of thing, there should be postmortems done. Most companies don't like to do postmortems on their capital expenditures. I've been a director of a lot of companies over the years, and they've usually not spent a lot of time on the postmortems. They spend a lot of time on telling you how wonderful the acquisitions are going to be, or the capital expenditures, but they don't like to look so hard necessarily at the results.
Think of how refreshing the board of directors meeting would be if they sat down and, now we'll spend 3 hours examining all our stupid blunders and how much we've blown.
And then after that, the compensation committee will meet. No, that is not going to happen.
Right.
Okay, Area 5, please.
My name is Keller, Harpel Keller from Portland, Oregon. 2 questions, one of a personal nature. Obviously, there are many, many people here today, and I wonder if one of the true patriarchs of the investment business is here today, Phil Curray.
Well,
many of his friends and admirers would wish him well.
Phil, up till a week ago, was going to be here today. Phil is 101. Wrote a book on investments in 1924, and I've known him, Phil, for about 46 or 7 years. And Phil has made all the meetings for a number of years. Would be here today, and he broke a hip about 5 or 6 days ago, but he sent a message that he will definitely be here next year. And he will be, too. Sent a message that he will definitely be here next year. And he will be, too.
Second question has to do with Ben Graham. And he changed his valuation standards as the decades progressed. When he couldn't buy stocks below net, he changed his standards because the environment changed. Now, the world today seems to be at a much different place than in 1989 when the USSR collapsed. Even they are stumbling toward the free enterprise system. The Russian mafia is a perverse illustration of that. Now there is only one superpower in the world, the USA, and we must be extremely grateful for the men who put us on the track to the free enterprise system. Now, the free enterprise system is out of the bottle. It's not going to get back in. It seems to be expanding and accelerating around the world. With the resulting expansion of world trade, may that lead to a reevaluation of historical measures for measuring investments?
Well, my answer to that would be that I doubt it, but I also don't know. But I don't think that the end of the Cold War is something that I would factor into my evaluation of businesses. There are all kinds of events that happen, and their impact in terms of being quantified, very difficult to figure over time. Very difficult to isolate any single variable in a complex economic equation. So in terms of how the world is going to work 10 years from now, or the returns are going to be on equity in business, you know, I don't know what will be all the variables that impact on that. And obviously, right now people are very bullish about the fact that those returns, or something like those returns, will continue. But I would not rely in making such a projection on the fact that the Cold War has ended, or really any political or economic development around the world. I don't know how to predict future earnings of American business. And when I look at all of the great historic events of the past, nothing there gives me much in the way of a clue as to which ones would signal major changes in profitability of American business. Charlie?
Well, I think you raise one very interesting question. If the rest of the world becomes very much more prosperous, as it will if it adopts the free enterprise system, which investments are likely to do best? I would argue that the Cokes and Gillettes and so on are likely to be helped by a great increase in prosperity in what is now the third world. And I'm not so sure that's true of a lot of other businesses.
We like the international businesses we have, and as I say, that our three top holdings all have a major international aspect to them, and really in aggregate a dominant international aspect to them. And there's no question in my mind that a Coke will grow faster outside of the United States than in the United States, and the same is true of Gillette, and really the same is true of American Express. So that's built into our evaluation of those businesses. But I felt that way before 1989 too. I mean, it's very hard to evaluate how the ball is going to bounce generally, but around the world. But it is a plus to have products such as Gillette has or Coke have that have demonstrated the fact that they travel extraordinarily well around the world, that people crave those products, and that they're going to no one's going to find a way to do it better than those two companies in their respective fields. So, and they sell an inexpensive products. So all of that's going for us. But in terms of how stocks generally sell, or the profitability of American business generally is in the future, it doesn't help me. Generally sell, or the profitability of American business generally is in the future, it doesn't help me anymore.
Hi, my name is Bartley Cohen. I just want to thank you for a great weekend, and my question is, after you bought Dairy Queen, I heard they put Coca-Cola into all the stores, but yesterday when I went to the Nebraska Furniture Mart, they said they don't take American Express. And my question is, do you encourage the subsidiaries and the companies that you have stock to use each other's products, or do you leave it up to the management of the subsidiary?
Well, that's a good question, and it does tell you something about the Berkshire method of operation. We tell each subsidiary to run their business in the way that they think is best for their operation. And Borsheim's takes American Express, See's takes American Express, the Furniture Mart doesn't, for example. But that'll be true in other areas too. If Harvey Golub at American Express, who has absolutely done a sensational job for us, if he wants to talk with, or have his representatives talk with anybody at any of our operations, you know, we're all for that happening, but we will never tell a subsidiary manager which vendor to patronize or anything of that sort. once we start making decisions for our managers in that respect, then we become responsible for the operation, and they're no longer responsible for the operation. They are responsible for their operations, and that means they get to call the decisions, and they should do what is best for their subsidiary, and it's up to any other company that wants to do business with them to prove why that is best for them. And that's the Berkshire approach to things. And I think on balance, our managers like it that way. So they're not getting second guessed, and somebody can't go over their head. I get letters all the time from people who are trying to jump over the heads of our managers, and they want us to say this advertising agency should be used or that and that sort of thing. And it doesn't work at Berkshire. They deal with the managers of the businesses, and they're not going to get around them. Charlie?
I love your answer. It gives Warren lots of time to read annual reports at headquarters.
Area 7.
Hello, my name is Steve Errico. I'm from New York. What do you think is likely to happen with respect to the tobacco settlement, and what do you think should happen? And secondly, McDonald's and Dairy Queen are similar businesses. Was there a relationship between your acquisition of Dairy Queen and the disposal of McDonald's? Thank you.
Yeah, there's no connection in the second case. They have certain similarities, but there's certainly a lot of differences too. You know, a Burger King and McDonald's would be much more similar, or a Wendy and McDonald's, but Dairy Queen is much more of a niche than away from that. The tobacco settlement's interesting, just in terms of watching the dynamics of it, because one of the things in labor negotiations is always a problem is that when you, as a manager, you have a labor negotiation, at the end of the negotiation, you as management are committed, and basically the union isn't, because the union is going to have a vote on it, and that's just the way it is. I mean, you can't get away from that, but it is not fun to be in a negotiating position where you're bound and the other side is not bound. And although that wasn't totally contractually necessarily the situation in the tobacco area, it smelled like trouble to me for the tobacco companies, whether you feel they should have had that trouble or not, but it smelled like trouble to me when they were bound and you had another side that was not bound in any way, and where there were lots of political considerations, and where there was a lot of time was going to expire. I mean, that did not smell to me like a deal that would stick. And I don't know any of the tobacco executives that were involved in that, but I don't know how much they agonized over getting in a position where they were bound and the other party wasn't. But I can tell you from labor negotiations that's not a pleasant place to be, and it's not a great strategic place to be. Charlie, what do you think on that?
I don't feel I've got any great expertise in this situation.
Well, neither did I, but Okay, Zone 8, please.
Hello, I'm Jamie McMahon from Birmingham, Alabama, and I was hoping that Mr. Buffett and Mr. Munger, y'all would expand a little bit on your ideas of an inheritance and the positive and negative influences that can have on your heirs, and what you might be able to do as a business person and an investor and as a parent to sort of mitigate those negative influences.
Yeah, well, I quoted, I think Kay Graham was quoting her father at the time, but some years back, as saying, if you're quite rich, probably the idea of leaving your children enough so they can do anything but not enough so they can do nothing is not a bad formula. I think if you're talking about people that aren't quite rich, I've seen, socially I wouldn't have a system that involved inheritances, but recognizing the situation that exists, I think probably at lower levels that leaving to the children in this society is perfectly okay. But I believe enough in a meritocracy that if I were devising the system with a consumption tax and everything, I would probably make inheritance a form of consumption, and it would be very heavily taxed. Because I don't believe that because you happen to come out of the right womb, essentially, that you are entitled to live an entirely different life than somebody who wasn't quite as lucky in terms of womb selection. But in my own case, you know, I follow enough so they can do anything, but not enough so they can do nothing. I think that society showered all these. I was very lucky. I was wired the right way at the right time in history to do very well in this kind of a market economy where, as Bill Gates has told me, if I was born some thousands of years ago, I'd been some animal's lunch. You know, I don't run very fast, and there are different assets that are useful at different times, and you know, I'm not wired to play championship bridge or championship chess, or I'm not wired to be a basketball star or anything. It just so happens I'm in an area where it pays off like crazy to be good at capital allocation, and that doesn't make me a more worthwhile human being than anybody else or anything. It just means I was lucky, and should that luck enable many generations of people that I would have some reservations about that. So that's my own feeling on inheritance. But Charlie has a bigger family, and he can give you a better answer.
Well, I feel in a capitalist system that there should be an inheritance tax, and that once that's been imposed and paid, what each person wants to do in his own testamentary arrangements is up to that person. I see very few people that I regard as ruined by money. Many of the people that I see ruined who have money would have been ruined without money. And I think the percentage of the people that are going to be living the life of the French aristocracy before the revolution is always going to be very small, and living the life of the French aristocracy before the revolution is always going to be very small, and there are plenty of grasping people to take the money away from the whole class of incompetents ruling the world as their money cascades ever higher. So I like a fair amount of charity, and certainly some testamentary charity is okay, but I feel it's an individual choice that people have to make.
You get a choice there. Number 9.
My name is Samuel Wong from Irvine, California. I have 2 questions. Question number 1, do you think the USA market is overvalued today? And question number 2, would you buy Berkshire Hathaway stock today? Considering the fact that they have a nice run up? If yes, presuming I have a kid, 20 years old, and he has $150,000 to invest in Berkshire Hathaway, and he won't need the money until 5 years later, gradually, would you recommend to buy A share or B share or the combination? Thank you.
If you decide to buy Berkshire, I don't think it really makes much difference whether you buy A or B. But we don't make any recommendations about whether people buy or sell Berkshire. We never have, and that's a game we don't want to get into. In terms of overvalue, the question of whether the market's overvalued generally, it's simply as we said last year here in the annual report. It's not, the general market is not overvalued if 2 conditions are met, which is, in our view, which is that interest rates remain at or near present levels or go lower, and that corporate profitability in the U.S. stay at the present or close to the present levels, which are virtually unprecedented. Now, those are a couple of big ifs, as we pointed out, a lot of the stories that came out after the annual report would emphasize one aspect or another, but it's simply, and they say, what does he mean by that? Well, it means exactly what I say. If the two conditions are met, I think it's not overvalued, and if either of the conditions is breached in an important way, I think it will turn out to be overvalued, and I don't know the answer, which is why I put it in the form that I did. It's very tough at any given time to look forward and know what level of valuation is justified. You do know when certain dangerous things appear, and certainly if you're predicating your answer that stocks are okay at these prices, you have, if you come to that conclusion, you have to also come to the conclusion that, in our view, that corporate earnings at present levels are likely to be maintained, and that's a conclusion you would have to come to. I don't think it's obvious that that's the case. Area 10, please.
Good afternoon. My name is Jamie Harmon, and I'm from Boston. You say that companies should only spend $1 on capital expenditures if it will create more than $1 of market value. I'm wondering, how do you determine this? Is it based on A, historical returns on capital, B, a qualitative judgment of the company's competitive position, historical returns on capital, B, a qualitative judgment of the company's competitive position, a quantitative projection of the returns on capital, or D, something else?
We can say, to date, every dollar we've retained has been worthwhile, because on balance, those dollars have produced more than $1 of market value, and it's actually, with a great many companies, you could say that now, because things have turned out so well. But it would be a case, the check on it is if after 3 or 4 years you found that the dollars we retained haven't created more of that in value, then the presumption becomes very strong at that point that we should start paying out money. But almost any management that wants to retain money is going to rationalize it by saying we're going to do wonderful things with the money we retain. And we think there should be checks on that, which is why in the report, in the ground rules, I suggest making checks on the validity of those projections. Charlie and I, if you asked us today whether the single dollar we retain from the earnings today we've got a use for today that will produce more than $1 of value, the answer is no. We do think that based on history that the prospects are that better than 50%, well over 50%, that in the next few years we would have an opportunity to do that. But there's no certainty to it. Charlie?
Nothing more.
Okay. Area 1, please. Charlie?
Nothing more.
Okay. Area 1, please.
Good afternoon. My name is Gary Bialis. I'm from Southern California. I want to thank you again for producing Can you tell me if the rule of thumb is still applicable regarding the statement in the owner's manual that the percent increase in the book value tracks pretty well the percent increase in intrinsic value? Or is the fact that you now have more owned businesses, especially ones like Geico and Flight Safety, mean that the spread between those two is possibly narrowed?
Well, the true have tracked pretty well over the years. I mean, compared to the record of most businesses that are publicly owned, I would say that over the 33 or so year span, our market price has tracked intrinsic value more closely than 80 or 90% of the companies that we view, probably 90%. But that doesn't mean it does it all the time. And there are times when the market, but that doesn't mean it does it all the time. And there are times when the market had the change in intrinsic value, and there are times when obviously then that it will lag behind. So it's far from perfect, but it's better than most. Ideally, we would like it to track it perfectly. If we ran this as a private company and we met once a year and set a price on the stock to have it traded once a year, and Charlie and I were responsible for setting that price, we would try to set a price that was as close to intrinsic value as we could, and that would be, to the extent that we could do it, it would be a perfect tracking. The market isn't like that, and the market responds to a lot of other things. So it's not perfect. It's not getting more perfect in our view, but we still think that Berkshire companies. Charlie? Companies. Charlie?
Nothing to add.
I'm Elizabeth Cruz from New York City. I have a question about Gillette. Another significant Gillette investor, KKR, recently sold over $1 billion in Gillette shares that they had acquired through Gillette's acquisition of Duracell. Knowing that KKR has also been a successful investor, do you see this as a negative signal about Gillette's future prospects, particularly on the eve of the launch of the Mach 3 razor? And what do you think their plans are for the remainder of their shares?
Well, I think they may have even publicly stated, I'm pretty sure they have, the Duracell shares, from which the Gillette shares came, were held by a specific investment fund that was formed in I don't know what year, but a given year, and which is scheduled to disband at a certain point. So those shares, whether they were of Duracell or whether they're of Gillette, were scheduled for disposition at some point within a given term. And I think that KKR made the decision, and they've made it with other stocks too, is to have maybe 3 or so offerings between now and that terminal date for their partnership. And why they pick any any given date, is up to them and their advisors. It means nothing to us. I mean, if they didn't have that kind of a fund and they decided to sell, it wouldn't make any difference to them. And I presume if we made a decision to sell, it wouldn't make any difference in their case. So we form our ideas of valuation independent of anybody else's thinking on it. But in the case of KKR specifically, they have a termination date on a partnership that own those shares and have to dispose of them one way or another between now and the termination date, and probably decided that with the quantity of stock they had that they were going to have several sales. The Mach 3 is terrific in quantity of stock they had that they were going to have several sales. The Mach 3 is terrific, incidentally. I've been using Mach 3. Area 3, please.
I'm Gertrude Goodman from Palm Springs, California. Mr. Buffett and Mr. Munger, there are many stocks that rise and eventually split. My question is, do you foresee in the near future a split for Berkshire Hathaway Class A?
Well, that's an easy one. No, the answer is no. We have no plans to split the A. In effect, we let people who want to split the A split it themselves into a B. So anybody that owns the A can have a 30-for-1 split any morning they wake up and want to have such a split. And Charlie, do you have any additional comment?
No, I think you said no perfectly.
We don't take that attitude because we're cavalier about how shareholders feel. We really think that in the long-range interests of Berkshire, that the policy we followed on not splitting has benefited the company and shareholders. Nothing dramatic about it, but I think that we have a better class of shareholders in aggregate in this room than we would have if we were selling at $3 a share or $30 a share or maybe even $300 a share. Area 4, please.
Good afternoon, Mr. Buffett and Mr. Munger. My name is Jack Sutton from New York City. I have 2 questions. The Japanese stock market has been likened to the U.S. market in 1974. With Japanese stocks selling at very low price-to-book values as compared to U.S. stocks, would it not make sense to invest in a basket of Japanese stocks or an index fund of Japanese stocks? Question number 2. Berkshire Hathaway tends to invest in companies with high margins and high return on common equity. Berkshire's investment in the airline business seems to have digressed widely from those principles. Could you elaborate on why Berkshire invested in the airline industry, and would Berkshire consider new investments in the industry in the future?
Going to the first question, the reason that, and I don't know the exact figures, the Japanese stocks would sell at a lower price book ratio than U.S. stocks is simply because Japanese companies are earning far less on book than American companies, and earnings are what determine value, not book value. Book value is not a factor we consider. Future earnings are a factor we consider, and as we mentioned earlier this morning, earnings have been poor for a great many Japanese companies. Now, if you think that the return on equity of Japanese business is going to increase dramatically, then you're going to make a lot of money. I mean, and you're correct, you're going to make a lot of money in Japanese stocks, but the return on equity for Japanese businesses has been quite low, and that makes a low price to book ratio very, very appropriate, because earnings are measured against book. And if a company's earning 5% on book value, I don't want to buy it at book value if I think it's going to keep earning 5% on book value. So a low price book ratio means nothing to us. It does not intrigue us. In fact, if anything, we are less likely to look at something that sells at a low relationship to book than something that sells at a high relationship to book, because the chances are we're looking at a poor business in the first case and a good business in the second case. What was the other question on Charlie?
Buying it.
Airlines. Oh, yes, I always repress everything on airlines. I don't want to. We've never bought an airline common stock that I can remember. So what we did was we lent money to U.S. Air for a 10-year period, and we had a conversion privilege there. It looked like it was a terrible mistake. I made the mistake, but we got bailed out. But we never made the determination. When we bought our stock, U.S. Air was selling at $50 a share or thereabouts, the common. And we didn't have an interest in buying U.S. Air at 50 or 40 or 30 or 20. And we got a chance to as things went along, all the way down to 4. And we never bought it. And we never bought American or United or Delta or any other airline. It is not a business that intrigues us. We did think it was intriguing to lend money to them with a conversion privilege, and it's worked out now because we got lucky, and because Steve Wolf came along and really rescued the company from right at the brink of bankruptcy. But we're unlikely to be in airlines, although, again, we wouldn't mind lending money to a lot of businesses that we wouldn't buy common equity in. I mean, that could happen again in various industries, including the airline industry. Charlie, do you have anything to say on either the airlines or the Japanese market?
Well, the airline experience was very unpleasant for us. The net worth just melted. It was like $1.5 billion, and it just went 100 million, 100 million, 100 million. And finally the cash is running down. It is a very unpleasant experience. And we try and learn from those experiences, but we're very slow learners.
Japanese market? Yeah.
Oh, the Japanese market. I suppose anything could happen. After all, we bought silver. But we have never made a big sector play on a country. In fact, we've almost never made a big sector play.
We would have to come to the conclusion the Japanese business, instead of earning whatever it's earning on equity now, is going to earn appreciably more on equity. I've got no basis for it. I wouldn't argue with anybody else feels that way. I wouldn't argue with them, but I have no basis for coming to that conclusion. And unless you come to that conclusion, you're not going to make good returns. I mean, unless that happens, you're not going to make good returns from Japanese stocks. You can't earn a lot of money from businesses that are earning 5% or 6% on equity. And I look at the reports, but I don't see the earning power now. Now maybe it'll all change. I mean, there's talk of, well, there's already been a small temporary tax cut, but corporate tax rates are quite high, as you know, in Japan, and they used to be 52% here in the United States. Now they're 35. So you could have things happen that increase corporate profits, but I don't have any special insight into that anyone that reads the press generally would not have.
There are also readings in corporate culture that have to be made. Owning stock in a corporation where you know that if shareholders or somebody else has to suffer, the choice is likely to be that somebody else will be chosen. That is a different kind of a company to invest in than one that thinks that the principal purpose of life is to keep some steam boiler company going in a particular community or something, no matter how much the shareholders suffer. I think it's hard to judge corporate culture in the foreign countries as well as we can judge it in our own.
Area 5.
Yvonne Edmonds from Cedar Mountain, North Carolina. I have a specific question, but not a trivial one. You regularly compare Berkshire Hathaway's performance to the S&P 500, which is very helpful and very interesting. But I haven't seen a correlation coefficient between the S&P 500 daily, from day to day performance, close, say, and Berkshire Hathaway's close. Now, it so happens for me, and I'm sure some other people in the audience, that I don't always have access to newspapers, or the internet for that matter, newspapers that publish Berkshire Hathaway performance on a daily basis, or even a weekly basis for that matter, or a monthly basis. It would be very helpful to know the extent of a correlation coefficient between those two variables. If you have that, would you let us know what it is? And if you don't, would you please consider calculating it in the future?
Well, it could be calculated, but I don't think it would have much meaning. I mean, it would be an historical correlation coefficient, which, you know, I would be very reluctant to have people place any weight in. I try to indicate even the limitations of the yearly comparison of the relative performance, because what was doable by us in the past is not doable today. I mentioned in my annual report the best decade I ever had on comparative performance by far was the 50s. Now, I don't think it was because I was a lot smarter then,